Welcome back to another episode of the LSCRE podcast. Yes, the LSCRE podcast. I'm very excited. I think this episode is going to be jam packed. We're going to talk about something that is probably the level above the base level of the alternative space. So we've got Joe Downs, the CEO of Belrose Group. They are a self-storage owner operator acquiring deals right now. And so often I get asked, hey, Craig, can you point me in the direction of other people? Maybe some people that do self-storage or other stuff. Well, here's a good individual for you to maybe pick his brain and see what offerings he has in the future, so long as it's compliant, of course. But we're going to be talking about the next iteration to the alt space and investing, which is self-storage. So Joe, thank you for coming on today.
Craig, thanks for having me. Good to be here.
Yeah, well, excited to get into the why and your thesis from an investment perspective, but let's take it back a couple of years or decades and talk about how you got in the chair today. What was like kind of your career path to becoming the CEO of a group that you are?
Was that a little millennial dig right there? A couple
No,
years slash
no,
decades?
no. I wish I had the ability to say I'm market testing all these
You,
things. I think capital raising might be a little easier.
you wouldn't be wrong. I'm just wondering about your strategy.
No,
Uh,
no, no, no. We're not on the golf course yet, so I'll be
okay.
pulling out any Jedi mind trick possible when we're swinging at the cricket club or your club
All
or
right.
somewhere around that vicinity. Hopefully, not too
Fair
far
enough.
from now.
Fair enough. All right. I already forgot the question.
So, how did you get to where you are today?
Yeah.
From taking it back a couple years, just a
I'll
few.
give you the abridged version. So, whether it was good or not, I've had to learn to reinvent myself. Probably 3 or 4 times over the last 25, several decades, as you like to put it. And I'm not going to go through every single one, but look, life happens, or economies change, or things don't work out. I was a financial advisor. I owned a bar and restaurant. I sold radio. I then started rehabbing and flipping, actually probably wholesaling, because I was broke after I lost the bar and restaurant. Wholesaling, I learned how residential real estate on the side, not as an agent, but as a wholesaler, then, renting and flipping single family homes in Philadelphia, all while having a second job, or a primary job. Then I ended up raising 1031 exchange money for, or really equity as 1031 exchanges for multifamily office syndications. And then the economy fell out in 2008, and it fell out from under us 2008, 9, 10, reinventing again. Learned how to buy distressed debt by way of a tax lien seminar. So I don't know how that happened. Built a company buying distressed debt. We buy resident. I still have this one. Buy residential charged off second mortgages. We're a fairly large player in the world's smallest pond, and then that hit a 3-year period, 2.5 3-year period, where the CFPB put overly onerous regulations on the banks, so they stopped selling said distressed debt. So now I can't buy debt anymore. Now we're out of business again. We didn't go out of business, but it wasn't a fun ride. And with time on my hands and, looking at what to do next. And I got an email, and I'm a real estate guy at this point. I've always wanted to be in real estate. I finally cut my teeth, wholesaling my first house in probably 2000, I don't know, 4, 3, 4, somewhere in there. So I'm staying in real estate. I think along the way, I also started hard money lending. I started originating loans. I was just doing whatever I could to make money. By the
Just
way,
being scrappy.
some of these things happened while I was married, starting to have kids. Like timing sucks, right? Thank God my wife had a great job. She carried us through there for a year or two while I'm trying to figure out, how to build up something again that hopefully doesn't implode. Anyway, I get this email while this is all going on, being scrappy. And it's about, the subject line was real estate with no tenants, toilets, and trash. So, I opened it. And I quickly put together that can't be true, because it was obviously the emails about self-storage, by the way. Buzzkill here. But you need tenants, right? And sometimes they leave trash, so there's no toilets. But so anyway, that wasn't what got me, Craig. What got me was there in the body, maybe the second paragraph, there was a line in it that said 80% of all mom and pop, or 80% of all self-storage facilities are owned by mom and pop owners. And that floored me because I was just in and I'm still in the distressed, charged off, distressed residential second mortgage space. It's a mouthful, right? In the secondary market and tertiary market of that. And it was the wild, wild west. So, and here, this guy's telling me that this commercial real estate asset, one I knew nothing about, by the way, not a damn thing about. Never rented a unit. If you had asked me what self storage was 8 years ago, I probably would have said, I don't know, it's those places with a lot of orange doors in a row. I have no idea
Public
what it is.
storage. I mean,
Yeah.
everything's kind of white gloved almost, or white kind of just copy pasted from a strategy perspective. And you said,
Yeah.
what year was this for historical context?
So when I get this email, it's probably 2016, 17, somewhere in there. But yeah, I did. Maybe I could have named public. I don't think I could have named Extra Space. Probably would have depended what I drove by. And I live near CubeSmart's headquarters, right? So I probably could have named them. But that's what I would have thought it was. It just lots of garage doors that are sometimes red and sometimes orange. And I've never rented it, so I don't know anything about it. And by the way, I used to go to a lot of commercial real estate conferences. I was in that space. No one was ever there from self storage. I never ever met a self storage operator. I didn't think they existed. I thought it was only REITs. That's who owned them, right? These big institutions put up these storage and that's it. Nobody else owns it. Here, I could not have been more wrong. It was 80% the other way, right? Now the number they've even broken that number down differently today, and we quantify it, qualify it, whatever, differently. But overall, that number's come down. It's probably, depending on what you read, it's probably still high 60s, low 70% is mom and pop. But then that comes down to, well, what are we looking at from a size perspective? Probably not unlike the multifamily space where you have the large operators. I'm guessing, I don't know, is over 300 units a demarcation line? Is that?
I would say, I mean, middle market, I mean, below middle market from an investment where mom and pop could do it, theoretically, is probably sub 150 units. And then above 150 units in most markets, like obviously 100 or 75 units in New York or San Francisco or Los Angeles, or Miami might consider it to be, institutional. But
Yeah.
for general speaking, middle market institutional assets is 150 plus units, about 20 million plus.
Yeah. Okay. So that demarcation line for us is going to be in square feet with your outliers, same issues when you get into Manhattan and your LAs and all that stuff. But so typically we're going to be, and what we do is we don't try to compete with them, right? So we're looking at a market. I'm trying to break down the market for you. We're looking at a market where maybe 30,000 square feet is the lowest the institution would go, and they would only go there if they had another facility in that market, right? So then you look at that and say, well, how many facilities under 30,000 square feet are there, and how many of them are mom and pop? Well, now they're like 100% mom and pop, right? Or 98 or 99%, right? And then you were mentioning middle market for multifamily. My company, we've acquired 20. We currently are managing, I don't know, 13 or 14. I don't know if we are considered middle market or not. We're not considered mom and pop, though, I'll tell you that. So most of these facilities are still mom and pop owned and run. So I'm looking at this opportunity here in commercial real estate where most of the market is actually probably out of touch with technology, the times, how to run an actual business. So my eyes lit up and I got excited and I bought the at-home course that he was offering at the time, and this was his name's Scott Myers. I don't know if you're familiar with him. He's the leading educator on self-storage in the United States. And so I bought his at-home course, went through it, then went to his academy. It was a 3-day event. One of those things where, Craig, I don't know if you've ever had those moments where you're like, oh my God, this is it. Like those nights I couldn't sleep.
Yeah,
Right?
it makes sense, and you're excited, and you're like, "Oh wow,
Yeah.
this kid's kind of the wheel spinning." Oh yeah,
Yeah, and it's not because this sounds awful because you're in multifamily residential, and I can understand how people get excited in that business. I've done it where you get to put a creative touch on something, right? You're buying something that's old and worn, and you need to you're going to come in and replace the Formica countertops. By the way, are there still Formica countertops?
Yes, all
I,
over.
I can't believe they haven't all been replaced yet.
Yeah, and we're looking to
Um,
buy them.
right. So you guys can go in and do these beautiful before and afters, and right, and it's like you've created gold, and you've made this transformation. It takes a special kind of idiot like me to fall in love and not be able to sleep at night over self storage, because there's nothing sexy about it. It is metal boxes. You hope sometimes they're cinder block boxes, right? But we want the metal boxes. We prefer them, right? But they're just, there's nothing to it. There's nothing sexy about it. There's no like, oh, did you see what we did with this one? Like, hey, we threw down some more gravel in aisle 4, right? She's a beaut now. She's draining better. We make sure it's fenced and secure and lit and security cameras and all that stuff. So it's not sexy from a visual standpoint, but God, it's sexy from a deal standpoint, and be able to get in there and to negotiate with a guy who's owned it for 20 years and it's his baby, and he's trying to decide, are you the right caretaker for this, and you negotiating that deal, but also at the same time saying, look, I'm going to bring this into the 21st century, and we're going to add a website, and people are going to be able to find us on your phone or on their phone, and rent a unit on their phone and pay for it on their phone every month without needing a check or cash. Like it's exciting. It's fun in that regard. And I realize, I probably sound like I'm geeking out over it, but that's how we geek out. It's that, what are the opportunities that we can take, we could see that we know we can apply what we know how to do here, which will create more revenue. And, just like multifamily, if we can grow the NOI, we're growing the value of the asset.
Yeah, and with that said, do you guys at the Belrose team, do you guys have a geographical focus? I know you're tucked away in the Northeast vicinity. Is that where a lot of your assets are, or are you agnostic throughout the country?
We're agnostic for sure. We'll go to where the deals are, but there's a chicken and an egg principle here. So we do market for deals. So where do we spend our time marketing and calling? We have a team of VAs that are calling these mom and pop facilities every day. Because we're in the Northeast, we're focused more on the East Coast. But believe it or not, Ellen, the closest facility to me is an hour and a half away. I live in Pennsylvania. We haven't been able to find one there. We're mostly Southeast. So North Carolina is our number one state. We bought more in North Carolina than anywhere else. And
Very
still
cool.
there.
Yeah.
So Georgia, North Carolina, basically the whole Southeast. And there's a reason for that. If I was on the West Coast, I'd be looking at the Southwest. 2 reasons. One, proximity, because we go to them. Sometimes I go to them to meet the owners before we even have a deal. So I have to be able to get there and travel, with relative ease. But also, outside of that, it wouldn't matter to me east or west, but it's where the population's going. So people move south, and they move south because they get old. That's an age-old principle. And then, not getting political on your show here, but there has been a political environment over the last however many years that have forced migration south. And that's not my opinion. Those are just what the numbers are telling us. So we want to be where the people are going to be, right? Where the people are moving to, because they're bringing their stuff and they got to store their stuff, right? So, and that's a basic principle for us. I'll look at any market. If it's stable or growing, if it's declining, I'm not interested.
So with that said, what are the principles that you need to feel comfortable with an acquisition? What's kind of like, if you could kind of, every deal is different, but they all have similar characteristics. So when you're looking at an acquisition, what are some of the boilerplate things, or maybe a recent example of what you did and what you liked about an acquisition, or just maybe what you look for generally?
Yeah, well, for us, it's simple. And we actually teach this. So I mentioned Scott Meyer's Academy. I not only teach there, my Belrose team took over the entire coaching and mentorship programs on all the fulfillment. So
Very cool.
This is what we teach at the Academy, and after the Academy, and on weekly calls with folks, and mastermind meetups and pods, etc. Everything starts with the market. If we don't like the market, why are we even talking about the facility? So for us, it's the market. And for the reasons I just mentioned, we want it. One factor is population growth, either population, a steady population, a healthy, again, doesn't have to grow. It's just got to be there. And then some other factors will come into play. But growth helps everything, right? So we got to have a steady market from a population growth standpoint. Then we're looking at median household incomes, poverty, crime, and then there's a couple other factors that we're toying with as we don't necessarily teach it yet, but it's in our own internal incubator as why we think this market is better than that. But keep in mind, and I get this question all the time, especially with people who are new, or they show up to the academy for the first day, and it's, well, I live in Atlanta. Is Atlanta a good market? Yes and no. Storage is local. So we look at national trends? Do people tell me all the time, oh, storage is down this year, storage is up there? I go, where are you? Yeah, in general, it may be up or down, but where? That's nice to know, I guess, from an economic standpoint. But for the facilities I own, I don't care if they're up or down in New York. I'm in, Roanoke Rapids, North Carolina. Why does what's happening in New York matter to me? We are a 1-3-5 mile market or 10-15 minute drive time, right? It matters what happens there. So this, what I said to this person, this example they asked me, I was like, you give me 20 markets in Atlanta and I'll show you 10 good ones and 10 bad ones, or 15 good ones and 5 bad ones. It's not about the area in general, with the exception of 1 or 2 states where it's just an economic issue from what you can get from rent standpoint and their disposable income. And Mississippi and Alabama are tough. It's tough to find deals there. Tough to build deals there too. Does that mean people aren't doing it? I don't know. Maybe they're smarter than me. They figured something else out. For us, it doesn't matter. That's why I say we're agnostic to state. It's the market. It's literally, I'm agnostic to city. I'll go to Chicago. Well, I don't know if that's Chicago, but I'll go to Illinois, right? In a suburb of Chicago, no problem, right? If the market fundamentals are there. So for us, it's really all about the market first.
So are you looking for like certain home square footage and incomes in an area essentially? Because, naturally you have storage because you have too much stuff. Right. So are you looking for like areas that have got a certain amount of square footage where, hey, if they're downsizing or moving stuff, they need a place here. If everyone's in an apartment, well, great. That's probably not going to make them need self-storage. So how do you kind of factor that? Do you need more of like a bedroom community location versus a bunch of dense housing?
Yeah. So what's interesting, Craig, is we learned this business and everyone in the business uses kind of the same approach, right? We have a supply index. It's very simple and overly basic, which is why I said earlier, we're working on some things in our incubator, internally here, and testing them out using AI now that we can use AI and know how to use it. But in general, I'll give you what the industry does, and we do it too. It just, to me, isn't as good as it could and should be, but this is what the industry does. We look at the supply index. So that's just total square footage developed, not leased or unleased, occupied or vacant. That's irrelevant. It's just developed within the market we're measuring, divided by the total number of people. So it's the supply index is just square footage over per capita, right? From there, do we look at the number of single family homes versus apartments? Yes, we do. Do we look at industries? Yes, we do. Median household incomes? Yes. But to your point you just brought up, I think you were hinting at it or suggesting this, and you would be correct. You have to have disposable income to buy stuff, to need room to store stuff, right? So
But younger people, yeah, like millennials, just to interject here, as a millennial, it's like, hey, if I'm renting an apartment and I've gone through 4 cities, the first thing you teach yourself is any excess stuff is going to bog me down. So if I'm someone that's going from apartment to apartment to moving, I'm more nimble. I'm not going to need self-storage. But if I'm a family that's lived in a place for 10 years and I'm going from 4,000 square feet to 2,200 square feet because I'm an empty nester, that's when you would need something like that. And you probably want someone who's older than a millennial as your core demographic or age group there that's probably moving around, would be my guess, just intuitively speaking.
That's interesting. That's an interesting. I'm glad you said that because you're making me think. I'll throw some other scenarios at you, which are some that we see. But to tie off first, median household income, which is where you were headed with that. We look at a number. We as an industry, we say we want median household income to be 75,000 or more. You feel really comfortable there. You can go lower. We own where it's lower than that, but you're playing a game with, how do you buy it? What's the rate you can get versus disposable income? There's a ratio there that nobody knows exactly, but there's a ratio there that should be paid attention to. Obviously, the higher that median household income goes up, the more disposable income there is. However, here's what we don't know. To me, that's called flying blind. We're just taking the whole average of the industry. Well, that's great, but I've got facilities where they look identical on paper, but one completely outperforms the other. Now, why is that? Well, because we've found some things within those demographics that would suggest that maybe we should be digging a little deeper everywhere. You can get away with it most places, but now that we have AI, we can do that. Let me counter punch here on your what I think I just.
And I know nothing about self-storage. I'm just logically thinking as, putting my LP hat on here.
Yeah. What I think I just heard from you, and this will tie back into the previous question I was answering. What I think I might have heard from you is your experience as a millennial traveling and moving from city to city. But I think you would be more unique than others, because what the industry stats would say is that millennials use storage more than my generation.
Interesting. Okay.
At a 3-to-1 ratio.
Wow, that's concerning.
That's for you to be concerned about.
It's concerning for me. It's great for you. It's concerning that people have much junk. Like I purge stuff.
It's not that they have that much junk. You kind of nailed it. They're moving, but what are they moving from? Apartment to apartment. You move city to city, but if most people just move apartment to apartment within the city, right? Or back home with parents, depending on which kind of environment we're in, right? Or maybe in and out with parents, right? So why are millennials using storage more at a ratio? You're using it more because there's more of you too than my generation. We're the smallest generation, Gen X, and we use storage the least. It's very interesting. But you guys use it 3 times what we do, and you're bigger. The reason is because you're either staying at home or living with others or by yourself in apartments 8 to 10 years longer than my generation. But you're still accumulating all the same stuff. And
Fair.
What are they doing with apartment buildings? They're building them with the same number of units. Yeah, you're in the business. Why am I telling you? Smaller units.
It's all 1 bedrooms, not a lot of nooks, not a lot of cutouts, stuff like that, for sure.
So where's the stuff that you need and accumulate? I totally appreciate what you're saying. If you're going from San Fran to,
I know nothing. So I'm just, you are right. I was just curious.
But most people are staying within their geographical city or close enough that they're driving or whatever, right? So they aren't downsizing their stuff. What you described makes sense, and it's what you see in Europe, right? They live a very minimalistic life because everything's a little smaller. Like we were just there this summer, everything's just smaller but perfect. They buy their groceries every day, not they don't need 2 fridges. They wouldn't know what to do with 2 refrigerators in these houses in Europe, right? We have 2, and we just said the other day we need a 3rd, right? So it's like, for what? Frozen stuff, right? And just food we don't know. These people do everything small and minimal and fresh. We don't do that as Americans. So we're buying all the same stuff, but we're not. Your generation isn't living in the same house yet, right? So that's why I would just counterpunch back to that. But that's also answering one of the questions earlier, which is, what are we looking for? How the housing mix is part of what supports your storage facility. Do we want just apartments? No, we want homeowners too, but we want a nice healthy mix of all the above.
Makes sense. So if you were to kind of boil down the key 3 things you need to do an acquisition, or a couple of them, what do you need to see? Do you need to see like a certain gap in the rents, like loss to lease, we'd call it in multifamily, which basically means that maybe the self-storage owner likes his tenants. He doesn't have much debt on it. He's owned it for forever. He doesn't need to max everything out. He just wants a steady Eddie paycheck coming in. He's under market rate. Is it sometimes signage? How do you maximize, or just systems and efficiency? Can you talk us through kind of
Yeah,
what your kind of typical value add thing is, or maybe you do development? I'm not sure.
well, we started to do development too, but I love the question you asked. So I'm gonna give it to you as the I was gonna say the Holy Grail, but there's like 5 or 6. So let's
List them all. No, we can do. If there's
treat it
more
like
than I think about,
the parlay,
yeah,
right? The
yeah,
$10 parlay that pays $5,000,
yeah,
right?
the DraftKings special.
Right. Okay, so you nailed some of them because they're going to be fairly similar to what you guys see on your side, right? But I'm looking for the winning parlay conversation with the seller is, I've owned this facility forever. My tenants love us. We never raise the rates. I've actually talked to 3 recently that said they grandfather their rates. I hadn't had a conversation like that in about 2 years where somebody said I don't raise the rates or grandfather them. I've had 2 in the last 2 weeks. So we never raise the rates. We're always full. We're the lowest rate in town. The owner himself usually has 3 to 5 units that he uses. There's always a church that has 1 to 3 units. There's always 10. This is my parlay. I might be a 15-team parlay by the time I'm done.
It is a big payout.
Yeah, it's a big payout. There's always about 10 units or 5 to 10 units where the doors or the springs on the doors are broken that they just haven't gotten around to fixing yet, in a market where everyone's full. By the way, I already mentioned they're full, and everyone else is in the market. And there's always about 5 to 10, depending on how long they've been there and owned it, 5 to 10 customers, tenants who haven't paid in 6 months to 2 years, but don't worry, they're good for it. So you add all that up. Oh, that's just the conversation. There's no website, no marketing. The rates are painted on the side of the building, which I don't know, I don't know if
Pricing should be dynamic in that, not postered like that.
This is the opposite of it. And by the way, it's like sun faded painted on the side of the building.
Yeah, low hanging fruit.
Changed in 20 years. Yeah, that's my holy grail of parlays. Like, oh, no website, can't find on a phone. And by the way, Google doesn't even know it existed because I just drove by it.
You basically need to, if you don't meet the owner that day, right then, you weren't going to get your unit rented, is what I'm hearing.
Correct. Yeah.
Yeah.
No,
so then
there's no gate. Forget the physical aspect. Although sometimes, oddly enough, physically they're phenomenal because they care about them, right? And they take care of them. It's their baby.
Incredible bones.
They're just not. They're not operators.
Yeah. So that's good to know there. I mean, I guess my pushback would be, well, other people are seeing that data. Putting up 4 walls and a roof like industrial is kind of easy to do, so long as you identify the land. You're not putting toilets and tenants, permitting. It's substantially easier than, other commercial assets. So what's the counterpoint to saying, well, I can just develop this anywhere, right? How do you kind of look into that and kind of make sure that you don't get supply destroyed, like we're seeing a lot of multifamily markets right now, most notably Austin and Phoenix.
Yeah, well, you just nailed it. And I'm not going to wade into those waters. I don't understand why developers who know better develop where they should know better,
because they can get the money to do it and they can raise for it. So they don't do they do what's best to clip fees and make a buck today, and they'll just hope and pray for tomorrow.
Okay,
that's my theory and philosophy.
Like I said, I have no idea, and I'm not wading into those waters. I look at it and go, I don't know.
Questionable at best.
Yeah, we can see that in our space. And I'll cover all this. This is a great point. In fact, I was playing golf earlier today. We were talking about this with some fellas from Texas, or one guy flew up from Texas, and I brought up Texas as an example. And when he asked me about how do you know where to develop it, I said, well, we use the supply index. We go to the county. We look, does this area need storage? Meaning, a national average supply index that we are all comfortable with is like 8 to 10 square feet per person. So, and by the way, you have your extremes there. Florida, that's out the window because they have no basements, no attics, right? Manhattan, out the window, right? So normal USA, 8 to 10 square feet per person. You can see markets where higher, the equilibrium is higher. You can see markets where it's lower, but typically 8 to 10 square feet per person. So is this market underserved is, question number one. Two, when I put my whole deal together with land acquisition costs, development costs, I'm throwing up metal wall, pouring concrete pads. If we're just talking basic concrete pads, metal walls, and roofs, right? So yes, we're not building Taj Mahals. It's depending on who you talk to and whether the guy's doing it himself. I've seen guys build it for $50 a foot, all the way up to $75 a foot, non-climate control. So you could put your performer together and then ask yourself the question: if the market's underserved, that's great. There's places all over Michigan that the market's underserved. Can I build there? No. Why? Because I can't get the rental rate. So in Mississippi, there's places everywhere it's underserved. You'll never get the rental rate, right? So you triangulate your decision here on, is this worth my time? Can I raise money for this? Is this deal going to be successful based on those factors? But it starts with the market. It always starts with the market. And not only is it a good market, but is the market oversupplied or undersupplied, right? So that's how we start that development question. Now, Texas adds another layer, because I can check every box there and go, we're about to build the greatest self-storage facility that's ever been built from a profit standpoint. And then, because the zoning laws and the planning doesn't exist there, the zoning laws, wild, wild west, the guy across the state who just drilled 25 wells or 100 wells, I don't even know if that's a lot or a little, but he's cashed up and played golf with a guy who loves storage, says, I got a piece of dirt over there outside of Dallas or McAllen, Texas, or whatever. I'm going to throw up some storage on it.
Because it's easy.
He doesn't do the supply index. His buddy's a builder. He doesn't need a supply index. He's just going to build it. Who cares? Well, now guess who's not making money? Me or him, right? So you will see that, where they all go up together. Sometimes people make mistakes. They don't check county records for what's in the pipeline, and that sucks too. But
I'm sure CoStar provides this as well, or service like that nature that will tell you basically in the front end, like we do too, like 1 mile through my radius, what's the supply like that's there and what's coming. Ideally, nothing. That's what we're looking for. Yeah,
exactly. So, but because of, I don't think you get cowboys throwing up $30 million multifamilies. I think there's a reason maybe you hit on it, but it's not by accident, right? We can get cowboys building $3-5 million self-storage facilities where they shouldn't be building them.
Makes sense.
But it's more rare. It's very rare. I see it, but it's rare. But so for us, it's simple. You're going to go into a market, you see it, you check all those boxes. And by the way, once you're in there and you're in the county, now when Craig's coming along because he's got an idea and he thinks that's going to be a good market, and he goes, shit, we're 9 months behind Belrose. They're going to get their permits. There's no point. They're building 50,000 or whatever they're building. You're gonna beat it to another town, because you're not going to. What would be the point? You wouldn't even get the funding.
Makes sense. So then let's talk about kind of metrics that an investor could think about getting here, like boilerplate. What is the leverage point that you're typically looking to do? What's the debt look like? What are the kind of the projected AAR, IRR, depending on how you go with that, and kind of cash flow, yield stuff, things of that nature?
So from a retail investor standpoint?
Yeah, just go retail. Just, if you're going to invest, 200K is probably a class A share, or however you want to quantify it. Your average investor comes in for 75 grand, 100 grand. You know that data. Yes. What are they typically anticipating?
Yep. So the 20 deals we did, most of them we did raise 506c funds. I think 17 of them we did. Most of the deals we put out were probably in the average, I'm going to go IRR, of 15 to 18 was the range. The early deals we did, we blew the doors off that. That was COVID juiced, I say, is what I call it. COVID giveth, in storage, and then COVID taketh away. But those returns, because occupancies went through the roof, rates went through the roof, and then the values not only went through the roof for the cap rate, the interest rates were so low, the cap rates were compressed, but storage was so in vogue, and Wall Street was just buying any cash flow they could get at that time because everyone else is getting crushed.
Well, also you're looking at your yield on a multifamily and industrial. You're like, wait, this doesn't make sense, but this is not really institutionalized, but it can be systematized.
Yeah.
This is probably something we should put our dollars into, right?
Yep. So
it's like kind of like before what mobile home parks are. Like they're getting more institutionalized as we speak.
You're saying that now, yeah.
Yeah.
Yeah. So there was that period where even everyone was even overpaying after all of that. So that was a challenging period. But for the most part, unless you sold, and that's what I was actually telling you, and we sold some in that period, and our investors saw ridiculous returns. It was great for everybody. The period after that, though, it's been challenging. We're still working our way out of some of those. But the answering your question is typically we would structure the deal with a 15 to 18 IRR. Sometimes they had a cash flow component along the way, a pref. Usually they did, actually, because our investors wanted it. That would be anywhere from 7 to 10. You know this, but I'll say it to your audience. It's not that whether 7, whether 10, whether 15, whether 18 wasn't whether we were being generous or not. It was what the deal would yield. All deals are.
Yeah, I mean, you could probably be in a more core area, like a better part in the Carolinas. Let's say you're in the kind of that tech triangle in North Carolina, right? And you're near the, Duke or UNC or something like that. That's going to probably have a more compressed cap rate and, lower return direct projection as some more rural area in a Tennessee or somewhere else. So it's kind of similar in that regard.
And that 100%. So, and that's part of the when you're selling those, pitching them to investors, that's part of the pitch. Well, I want the 20, I want the 20% return. Like, well, first of all, it's really hard to come by these days. Second of all, I mean, I can make it say what you want, but that's not that's not what we're in this business for. But to get that, you have to go to where the deals have the proverbial hair on them, so maybe a little more rural, and can we manage it and actually, deliver that? Or, hey, look, this is a great deal. Let's pick the Carolina Triangle you just spoke of. Yeah, there's no way I'm delivering a 20% yield deal in that area, no matter how off market and how clueless the seller is. Right? There's still land value. He knows it's going to be worth at least this much. So, that might have been a 12, 13, 14% yield deal. And it, for us, by the way, you didn't ask this, but I'm telling you, it became really hard to manage a group of investors' expectations and wants and desires. That's the hard part. I don't know if you've raised capital yourself. That's the hard
part. That's what I do.
About this business that people don't appreciate. It's really hard, and everyone's got an opinion, and everyone's right. So, at one point we made the mistake. I don't know if it was a mistake or not. It feels like it was today, of bifurcating the return. So we had an A share and a B share. And the A share was for the guy that wanted the cash flow now and took a haircut on the overall return. The B share was, I don't need cash flow now. I'll take more of the back end. That's great. It satisfied a lot of investors, but that's also hard to explain to every investor, especially when they're new. So now you're cannibalizing your ability to raise money because you're just creating confusion. Confused mind is a solid system.
Yeah. We have the same philosophy. Everyone's common equity. We don't put pref in our deals. So everyone's probably pursuing cash flow. Just a matter of, are you going to be an A, B, or C share investor, which is either $50K or $1 million or $500K investor. So depending upon where you fall in there, there's no, hey, preference. Can I just have a cash flow sweep or something like that? It just doesn't work that way for us either, because it's on, a retail investor, basically a typical LP in our deal who's kind of investing that ticket size. Average investor is about 150K, 200K. You don't want to make them more confused and put them in a bucket. And guess who gets pissed off if, there's no upside there? That person who took the back end comp.
Yep. Yeah. So we learned as we went. And here's what we really ultimately learned is one of my partners, he wanted to move out of the business. It's me and another partner now. Even though my background was raising money, I'm the CEO. I've got to run everything. Plus, we're running the mentorship, and we're doing development. So I just came to the conclusion, I think it was maybe last year, middle of last year, you know what? We're not good at this. We are not good at raising money. Let's stop pretending we are, and let's go find a partner. So we went out and found some institutional partners, small institutional partners, and they write the $1 million, $2 million check now if that's what we need from an equity raise standpoint. So we just focus on sourcing, evaluating, negotiating, underwriting, and closing self-storage deals or building them. We've moved into pro storage, developing pro storage, iOS storage, and we run this whole academy and mentorship program. So what I tell everybody, whether it's podcast or live in person, self-storage is what brought you here, but every derivative and tangent of self-storage is what keeps you here, because it's so interesting. It's so neat what you can do once you get into the self-storage space and really understand that mindset of how we do that, how we do what we do. We source, how we look at an industrial property and say, all right, it's got 20,000 square feet of self-storage on it, but I could also park boats and RVs over here, maybe build more, maybe just go carports, or just throw down gravel and we can park fleets of cars or trucks or whatever. Or what's the highest and best use of this piece of dirt? Or, one of my favorite things, I haven't done it yet, but we're looking for it. I've got a team out looking for it now, is those old big box Kmarts, right? They are the perfect combination. They can be the perfect combination of self-storage, pro storage, or boat and RV storage, all in one property, and all designed to meet the needs of what that community actually needs. So not oversupplying any one of them.
Yeah, it's highest and best use on the new property that's kind of rendered obsolete with retail kind of changing. That's fascinating. So yeah, that said, we're coming close to the 45-minute mark, but I don't want to miss out this point here. Talk about AI and how you've implemented it. You kind of teased this before we went on and then have teased it so far. You mentioned AI is really, kind of making your life a lot better. Can you kind of touch and talk about how you've been able to implement that and execute on it?
Yeah, well, I won't get too doom and gloom, but more and more people I'm reading, AI is going to be displacing the workforce. So regardless, PSA, you got to start leaning into it. You have to get on ChatGPT and ask ChatGPT how it can help you understand what it is and what it does. That's the beauty of it. Just ask it. It'll tell you. It will teach you what it is and how to use it. But how are we using it? And I say that, by the way, because that's step one. Step two is now, how do you use it in your life, whether it's in your real estate business or some side hustle or whatever you're doing. It's not just for writing better emails, folks. Trust me. So here's a real application that we use. We built internally a GPT. We've built 3 of them now. The one that is the most tested and almost ready for us to just hand over to our students is, we're still tinkering with the name, but it's basically a market underwrite. So I've made the point several times so far in this podcast that the market is everything for us, and I'm sure it's no different in multifamily. But for storage, for so many reasons, it's just critical. That's the first piece of the equation. To do a market study typically takes us, well, not me anymore, I'll do them, but when I used to do it, if you really did a thorough study, 30 to 45 minutes, right? And when you're underwriting deal after deal after deal, it really adds up time, which is why we start with the market study, because we used to do the underwrite and then go find out we don't want to be here in the market, and then we just wasted time. So we developed a GPT. The GPT just performs the tasks that one human would perform, whether it's go to this website and find this information, go here, get that, go here, get that, check this, do that, do it. That 45 minutes now becomes 4 to 5 seconds, right? Think about that. And it's performing at a higher level function than what we are doing as humans. It's gathering more information than we even asked it to search for, because we also prompted it to tell us if there's any other specific or interesting information about that market that we never would have been able to find out on our own, right? So we ask it to do that as well. And then, of course, when it spits back that answer to you, We have it telling us is this is what else to look further into. It gives us a score. It tells us if this, great market, not a good market, run like hell. If it's not run like hell, look at this, look at that. So there's follow-up functions for it. We can have it perform the follow-up functions. It's incredible, Craig. And that's just one. Soon we'll have it do the full underwrite. And then I said to Jack yesterday morning, Jack's my head acquisitions. I said yesterday morning, we were talking about all the broker OMs that we get in our emails every day. I said, this give me a month or two. We'll have these things underwritten while they're in our inbox.
It's incredible. Any other tips and tricks on AI and how it's helping you, or is that all you want to leave it for now and they can find out some more secret sauce if they join one of your webinars or seminars?
AI is going to be drinking like a fire hose, so I don't want to overload anybody. I think get on ChatGPT, set up a personal profile. If you don't know how to do that, ask GPT, how do I set up and personalize my ChatGPT? And it'll walk you through step by step.
I love
Don't
that.
wait, do it.
Yeah. And that said, you also mentioned you kind of had some personal beliefs about how you run your life. It wasn't like a hot take per se, but it was just some principles you could kind of give some knowledge for maybe people who are closer, get starting their career, whatever it may be. But what are some wisdom you can pass down to the listeners here of all ages, perhaps?
Yeah. So there's a phrase I use that's basically, you have to mind your kitchen. And when I owned a bar and restaurant, I had the opportunity to own a bar and restaurant because I bartended at that bar for, I don't know, 10 years. So I knew the bar. I had managed the bar when it was only a bar, and I knew everything about bars, right? That was easy. I knew nothing about food, the kitchen, food preparation, kitchen staff, what happens back there.
Cleanliness.
Nothing. How about just zero? I knew nothing. So I hire a chef and I turn it over to the chef and say, all right, we're going to run this thing. It's going to be great. And the first 6 months or so was great. And then, this business tails off. Kind of bottom line, ended up going out of business. What pulled me down, what sunk me, I could never recover, was the kitchen, right? I had no idea what was going on in the kitchen. And by the time I found out, it was too late. So, and I actually made that mistake in storage. So I made the same mistake twice. And I like to admit that and say that as much as possible because I'll never make it a third time.
Yeah.
And I've made it in storage. We turned over our operations for facilities, and more importantly, I turned away and focused on acquisitions and didn't stop and slow down and spend the time on who was minding the storage kitchen, the actual operations at the facilities. And unfortunately, we had a self-described expert who was anything but. And we're okay in most places, but we took a beating. We took a beating, and we're still digging out. But that's actually the beauty of storage is you could survive. You could survive almost any market in storage. So mind your kitchen. Second piece is get help, get coaching, get training. Don't try to do it alone. It's always worth it. People at our academy ask me, with whatever it costs, whichever package they buy, is it worth it? And I tell them story after story. We save anywhere from 3 to 10 times that. The fee, the mentorship fee that you're being asked to pay here to learn how to get into this business and create unbelievable wealth, we typically save people on their first deal 3 to 10 times that fee just on the first deal. Forget about the money you're going to make. We typically save that in the negotiation. Like, come on, get a mentor, get a coach, whether it's multifamily, storage, mobile home parks, land flipping, get a mentor, get a coach. It's worth it.
I love
Always
it. And actually, I couldn't agree with that more. And the second thing I'll add to the get a coach, get a mentor, because how my life's been enriched by other people is incredible. I can't speak to it enough. And that's probably my favorite thing about this kind of private equity, quasi, syndication, private capital raising space is the people that you meet along the way, because you get a lot of very impressive and very fun and cool people that you get to break bread with, throw some back with, play some golf with, you name it. It's one of the perks to the job. But the final thing I'll say to that, to add to it, is meet people in person and go to events, go to meetups, start accumulating contacts. And, no one can do this alone. It takes a village, and get your village going, because you don't know this person can introduce you to that person. You don't know when you need a favor or a reference in the future, and also do favors and help people out if that can
Yep.
kind of move them along. Joe, you've been a great guest. I look forward to having you again in the future. We can kind of break down the latest and greatest and how you're implementing the newest with AI, kind of, an overall holistic update to the self-storage world. I want you to be the outlet for this program here. But with that said, where can people find you, reach out to you, learn more about you, see a seminar, the whole nine?
Yeah. Best way to reach me is just my email, joe@belroseam.com. That's Joe at Belrose, BELROSE, A as an asset, M as in management.com. Our website's belrosegrp.com, belrosegrp.com. Please email me. I get emails all the time after the podcast. I will respond to you. So I talk to most people. If I can help you. To Craig's point, we help, we give back, we teach, because I've been helped. I've been given to. You nailed it, Craig. It's an amazing, regardless of the asset class. The communities are all amazing, and we have a saying in our mastermind: if you want to go fast, go alone. If you want to go far, go together.
Couldn't agree with that more. We will leave you on words of wisdom there. Joe, thank you for being a part of the show. To the LSCRE community and listeners, we are grateful for you. Look forward to hopefully meeting you wherever you are, not too far from now in the future. For those who are listening, we appreciate you, and we will see you next week. Peace.